It's a crazy market out there, and I'm hoping that tonight we can cover enough ground so that people can get an idea, what exactly is happening in the bond market, in the Treasury market, what it means, what the challenges are and what the opportunities are. So, Lee, I'm going to start with you. You are the author of a new book, Rigged Money, right?
I said you could just
Beating Wall Street at its own game, which came out in December. And you know, it's funny. Everyone always complains about the markets being rigged, but the bond market right now, the Treasury market, is the most rigged market in the world, isn't it? And I'm hoping you can tell us a little bit about what is the danger there for investors with this, with the Fed having this type of control over the market.
Well, first of all, and I think Bill's going to talk a little bit in a moment about this has happened before, but I think it hasn't happened in recent memory where the government is basically manipulating the market, which they always do to some extent. But really, the whole design is to punish savers and punish people who are trying to retire right now. And I think that I don't think the Fed sits around thinking how can we hurt somebody who's living in Florida and trying to live off dividends and interest. But I think it's important to note that there is significant risk and significant danger when this ends. And I don't think it's going to end anytime soon as far as a low rate environment. But it forces the individual investor all the way up to institutional and pensions and all market participants to do dumb things, like have to seek out risk that they might not have wanted to seek out, have to seek out perhaps lower credit quality than they might want in their native environment, and really take on a different type of portfolio than they might want to in a more reasonable, normal market.
Bob, what is the danger? Lee said before, at some point it's going to turn, right? And it might turn before 2014. We'll see. The Fed updates every quarter and that stuff. When the turn is, do you subscribe to Lee's theory that it's going to be scary and fast and dangerous?
I think it'll be scary and fast. And if you think about retirees, for instance, we mentioned, today they're between a rock and a hard place, right? So they can't go into a 10-year Treasury and earn 2% because when interest rates rise, right, the value of their bonds will fall, and they'll be sitting on bonds that are 85% of what they were originally valued at. On the other hand, if they stay short, which is what I think most people should do, and earn 0.25% or 0.5%, well, what they're looking at in a world where inflation is running at 2.5% is negative returns on their money, right? So they're in this place where they can't earn enough money to pay for their cost of living, and they can't go long because when the market does turn, the value of their portfolio will decline by 15%. So it's a very dangerous, and that's forcing people into going into dividend-paying stocks, preferred stocks, and other other things that
they also could lose 10 or 15% as well, though, and I think that's the rub is.
I want you to explain how that exactly happens, how quickly, especially in the long duration bonds, right? Because we talked about that. A lot of people are being sold these things, right? You're chasing yield, right? Do the long duration. But tell me about the dangers of that.
Well, I think it's very, if you just bring it down to street level, you have something called duration, and it's just a measure, a guesstimate of how much, up or down the value of your bonds are going to, have on a 1% movement in, say, a 10-year. Okay, it's very simple. So if you're buying something like the ETF TLT, the duration, Bill, you can correct me if I'm wrong, was about 14 to 15 right now.
Yep.
And what that 14 to 15 means, okay, because this is kind of geeky talk. It means that if the 10-year moves from 2 to 3, you're going to lose 15%. 30-year Treasuries last year were up 20–30% up. Everybody loves that, but it's because it was moving from over 3% down to below 2. And so, we talk all the time about global macro and, rates are going to be low for a while. But I think what you don't understand is that all of us are short for a reason, because you could have a 10-year go from 2%, or even the German Bund to go from 2% to, say, 3%. Doesn't bother Bill. I mean, that's just, it's still low rates. Is that going to kill the housing market? No. Is that going to kill, spending? Is that going to kill the U.S. economy? No, it doesn't mean anything. But if you just went out and did that, and you see on your statement, I'm down 15, 20%, you're going to react. You're going to panic. And then people like me are going to take advantage of that situation. I mean that in a bad way, but,
Not for you.